Welcome to this explainer. Now, let's be honest. If you've ever stared at a price chart and just wondered why on earth the market suddenly reversed the exact second you entered a trade, yeah, you're definitely not alone. We've all been there. Today, we are on a serious mission to completely demystify institutional trading. We're going to break down how you can stop trading like the emotional herd and instead start trading right alongside the big players using a highly structured, totally mechanical playbook. To really understand why this playbook is absolutely crucial, we have to grasp the sheer scale of the playing field we're on. The Forex market alone sees a staggering daily volume of $6.6 trillion. Just think about that number for a second. Retail day traders like you and me, we absolutely do not move this market, not even a little bit. It's the central banks and those massive institutions allocating billions of dollars across the globe. They're the ones driving the price action. We are literally swimming with whales. And this sets up a classic David versus Goliath scenario. But here's the thing. David shouldn't be trying to fight Goliath in this market. Retail traders, they often operate as this highly emotionally charged group. When fear and greed take over, they form a herd mentality, getting trapped in really bad positions. Institutions, they're on the completely opposite end of the spectrum. They're entirely mechanical. They rely on algorithmic execution and massive order flow to get the absolute best prices possible. So our goal today is to stop getting crushed by that institutional order flow and instead figure out how to ride its coattails. Okay, let's dive into this. Here is the mechanical step-by-step playbook we'll use to navigate the charts today. First, the institutional footprint. Second, drawing support and resistance. Third, the zone validation checklist. Fourth, breaks of structure and imbalances. And finally, number 5, precision entries and exits. All right, jumping right into part 1, the institutional footprint. Now, when institutions enter trades with literally billions of dollars, they just cannot hide their massive order flow. It's impossible. They leave behind these huge physical pieces of evidence on the charts, which we call supply and demand zones. You can kind of think of the market like a giant, continuous two-way auction house. A trade only happens when a buyer and a seller agree on a price, right? Well, a supply zone is created when aggressive sellers completely overwhelm the buyers. It creates this massive imbalance that just drives the price down. And conversely, a demand zone is an area of aggressive buying where demand totally overpowers supply, shooting the price straight up. Honestly, you can visualize these zones like a diving board that the big banks use to just launch the market. So you're probably wondering, how do we actually spot this footprint? Well, we are looking for extreme, highly aggressive price action. We want to see those sharp, V-shaped market moves, or maybe a sequence of 3 or more really aggressive, massive candles pushing hard in one direction. And why is it so sharp? Well, it's because institutions are actually intentionally triggering the stop losses of retail traders. Think about it. If retail traders short a breakdown and the banks suddenly reverse the price, all those retail stop losses become mandatory buy orders. And that is the exact liquidity the banks need to fuel their massive upward moves. Moving on to part 2, drawing support and resistance. Okay, so here's the exact mechanical process for drawing these out. Let's say we're looking for a demand zone, which acts as our support. Step 1 is finding that massive, aggressive upward move we just talked about. Step 2, look to the left and find the last red, opposite-colored candle right before that massive green explosion. And step 3, you literally just draw a rectangular box from the very top of that specific red candle's wick all the way down to its low. Boom, that box is your demand zone. Now, for a supply zone, which acts as resistance, you just do the exact opposite. Find the aggressive drop, locate the last green candle before the drop, and draw your box from its high to its low. But hey, keep this in mind. Context is everything here. You do not want to blindly draw boxes on a 5-minute chart without zooming out to look at the bigger picture. The daily chart is what tells you where the massive macro supply and demand zones actually live. If your 5-minute chart is telling you to buy, but the daily chart shows you're driving straight into a massive brick wall of daily resistance, you're going to lose that trade for sure. So use the daily for your big picture context and the 5-minute for your precise short-term setups. All right, let's get into part 3, the zone validation checklist. Listen, if you try to trade every single zone you draw, you are going to get chopped up, no doubt about it. To validate a zone and filter out all that market noise, you've got to mentally check these boxes. First, like we discussed, the move leaving the zone must be highly aggressive. Second, the zone must be completely fresh. That means the price hasn't already returned and bounced off it yet. Third, it has to align with your higher timeframes. And finally, the absolute best zones are the ones that swept previous liquidity. That just means they dipped slightly below an old support level, triggered a bunch of retail stop losses, and then rocketed in the opposite direction. Actually, let me really hammer home that freshness criteria. If you draw a supply zone and the price has already come back up, tapped that zone and fallen away again, you need to consider that zone completely dead. When the price touched it, the banks likely filled the remainder of their resting orders. So if you try to trade it on the second or third touch, there are simply no institutional sellers left to protect your position. The price is just going to slice right through it. Okay, moving right along to part 4, breaks of structure and imbalances. Drawing the zone is really only half the battle. We need ultimate confirmation that the institutions are truly in control. And a break of structure, or BOS, is the simplest, most effective filter you can possibly use. If a demand zone is created, but that upward push isn't strong enough to break above the previous swing high, it's a weak zone, period. It takes a ton of institutional money to forcefully break a major structural high or low. So if your newly drawn zone caused a legitimate break of structure, that validates that serious money is actually behind the move. Now, right alongside a break of structure, we want to look for fair value gaps, which are essentially price imbalances. This happens when the market moves so incredibly fast in one direction that buyers and sellers just couldn't pair up effectively. It leaves a literal empty gap in the price action right after the initial candle of your zone. And a fair value gap acts kind of like a magnet. The market eventually wants to return to fill that empty space, which brings the price perfectly back to your waiting zone. Which brings us to our final piece of the puzzle, part 5, precision entries and exits. So picture this. You're sitting at your computer, you found a perfectly valid, entirely fresh, untested demand zone that broke structure. Now what? Well, the most important thing is you do not chase the price. You have to patiently wait for the market to come back to you. Remember the golden rule. We want to buy low and sell high. We let all those impatient retail traders take the initial breakout while we just sit on our hands and wait for the price to return to the discount prices right at the origin of the move. So the crucial point here is setting strict, completely emotionless parameters. For your entry, you can either set a limit order right at the edge of your zone, or for a little extra confirmation, wait for a small double bottom or a rejection candlestick inside the zone. But, and this is absolutely huge, before you enter, you must know your exit. Place your stop loss just a few pips below the entire zone. If the zone breaks, the trade idea is invalid. Get out immediately. No hoping, no praying. For taking profit, use a fixed target. Something like a 3-to-1 risk-to-reward ratio aiming for the previous structural highs. Literally just set it and forget it. But wait, there is a massive secret trick to making this all work. How the price actually returns to your zone is just as important as the zone itself. You want the price to slowly, gently, steadily exhaust itself as it creeps back toward your zone. But if the price crashes back down into your demand zone with massive, highly aggressive red candles, abort the trade immediately. Seriously, cancel the order. That crash means overwhelming institutional supply has entered the market against you. You only want to catch the market when it's gently exhausting itself right into your zone. Now here is the harsh truth. You can do absolutely everything right. You can find a perfect fresh zone with a beautiful break of structure, a clear fair value gap, a nice slow return, and the trade can still fail. Trading is purely a probabilities game. The banks don't win 100% of the time, and neither will you. And that is exactly why we use fixed risk-to-reward targets. When your average winners are 3 times the size of your average losers, you only need to be right a fraction of the time to be highly profitable. So the tools are now entirely in your hands. You know exactly how to spot those massive footprints, how to draw the battle lines, and how to execute without all that emotion. The only question left is, are you going to continue getting trapped by fighting the massive institutional order flow, or are you finally ready to start trading alongside the banks? Take this playbook, pull up your charts, and start hunting for those zones. Thanks so much for joining me on this explainer, and I'll catch you on the next one.